Can we talk about the fact how when you go to buy a house, you probably only spend about 20 minutes in it and then maybe another hour when the inspector comes over? Shouldn't we be allowed to at least sleep one night in a house that we're spending hundreds of thousands of dollars on? Hi, I'm Jane Ayers, and this is Money Changes Everything. Renting isn't a failure. Buying is not a flex. The rent versus buy debate dismantled and a little depressed. Key takeaways. Buying real estate is not a guaranteed path to wealth. It's not easy to navigate a housing market that was shaped by a completely different economic era than previous generations. Once you get past the shame, you can make the right housing decision. I want to tell you a secret that the internet, your mom, the loud guy in your work Slack channel, and on that podcast got all wrong. Renting is not throwing money away. Buying a house is not a personality trait of only smart, organized, successful people. And owning real estate is not how most people build real wealth anymore. It's harder than ever to buy a home due to stagnant wages, ballooning student loan payments, a national housing shortage, and a few other things that are going to take decades to fix. I want to start by saying it's very important to me that you know you're not a failure if you don't own property, and that buying and investing in real estate has a chokehold on the narrative of how to build wealth in this country. It's not the only way, and in fact, it's a lot riskier than most people think. The rent versus buy debate has always been emotionally fraught. But lately, it's taken on the tenor of a toxic relationship, the kind where you know something's off, but the sunk costs and social pressure keep you in it. You don't even like hardwood floors that much, and 6 months ago, you didn't even know what a co-op was, but now you're obsessing over how to get into one. Why this debate is more confusing and dumber than ever. We're all trying to navigate a housing market shaped by a completely different economic era. The original wisdom around buying a home came from a world where homes cost $100,000. Interest rates were under 5%. Loans from the government helped a lot with down payments, and people stayed in one place for 30 years because that's where their job, family, and bowling league all lived. That's not the world we live in now. In the world you live in, housing prices have doubled in the last decade. Mortgage rates have hit a 20-year high, and the starter home doesn't exist in most metro areas unless you want to share a wall with 4 raccoons and have your living room look out over the town dump. You probably won't live in the same place for more than 5 years. You might not even work in the same industry. And yet, home ownership still gets held up like some kind of ultimate financial benchmark. If you rent, people assume you're doing it wrong. If you own, you probably had help from your parents, and all your friends hate you, or you're panicking quietly about cash flow. This is where things get messy, and also where I come in. Team rent versus team buy. For the past 4 years, my business partner, John, and I have run this very popular webinar called Rent versus Buy, where we go head to head, high school debate style, and talk about the pros and cons of each. We've been through a zero interest rate environment, a pandemic, tax law changes, and so much more in these 4 short years, but the talking points remain relatively consistent. Let's go ahead and give this the which Hogwarts house are you treatment, shall we? Team rent. You value freedom, flexibility, and not draining your bank account on a roof repair. You're not trying to build equity in a depreciating asset. You want a place to sleep and a home to keep in a city you live. Team buy. Basically Gryffindor. You crave stability, control, and the psychological thrill of being able to mount a TV without asking permission. You have cash for a down payment, and you know with 110% certainty that you're staying put for at least a decade. Here's what's important. Neither team is inherently smarter or more grown up. It's just that one is better for your actual life, and if you're not 100% sure which team that is, that's okay too. Let's start with team buy, the fantasy. Buying a home is often sold as the American dream, but in reality, it's more like buying a very expensive used car you have to live inside. The benefits of buying are real and can be an integral part of building real wealth, building equity, tax breaks, and long-term stability. Also, can we talk about the fact how when you go to buy a house, you probably only spend about 20 minutes in it and then maybe another hour when the inspector comes over? Shouldn't we be allowed to at least sleep one night in a house that we're spending hundreds of thousands of dollars on? That's just my personal opinion. The benefits of buying are real and can be an integral part of building wealth, building equity, tax breaks, and long-term stability. But the numbers only work if you plan to live in the home for 10 or more years. That number's sort of negotiable. 7 works too, but a long time, let's say more than 5. You have a large enough down payment in cash to avoid PMI, that's private mortgage insurance. You pick an area and somehow time the market well to ride a dramatic increase in property values. You can afford ongoing maintenance because you are now your own landlord. You aren't over leveraging yourself in a bidding war with people backed by a large cash gift from Daddy Warbucks. And even if one of these aren't true, the math might break. Let me be very clear. Real estate is not a guaranteed path to wealth. There are too many risk factors. And yes, you could get lucky. Maybe you bought in Austin in 2008 and sold 10 years later, right as a wave of tech companies moved in. Or maybe you picked a fixer-upper in a gentrifying pocket of Philadelphia, held onto it through the lean years, and walked away with a six-figure profit. Maybe you bought in Boise before the pandemic boom. These success stories exist, but they're outliers. Nationally, home prices appreciate at an average of 4% per year. It's a lot lower than most people think it is. That's slower than the stock market, much slower, and it requires a lot more hands-on work. Here's the national average home sales price data from the Federal Reserve. Let's break down a theoretical example. Average purchase price in 2010 was $224,000. Average sale price in 2024, 14 years later, was $419,000. So the time that you would have held that property is 14 years. You had a total increase of $195,000. Not bad. Overall growth, almost 90%, 86.9%. But if we average that out over the 14 years, that's only 4.62% per year, which is not that impressive. 86% growth on its own seems huge, but less than 5% per year is not that great. Also, this doesn't factor things like property taxes, maintenance costs, and mortgage interest paid. My point is that selling a home for twice what you paid for it seems dramatic. It seems like a huge win, but in reality, the annual growth actually falls short of other investing classes, like stocks. Historically, the stock market does better on average. Some say as low as 8% annually, some say as high as 20% annually. Depending on what data set you're looking at, the average growth can be even higher. For every breakout real estate success, there are stories like the couple who bought a condo in Miami in 2006 at the peak, only to watch it lose half its value after the housing market crash in 2008. Or the families who bought new builds in Las Vegas in 2022, then saw prices fall as interest rates soared and demand cooled. Or those who lost their homes entirely in the LA wildfires, the Houston floods, or the increasingly frequent once-in-a-century disasters. Real estate can absolutely be a part of a strong financial plan, but it's not a cheat code, it's not magic, and it's not immune to risk. Also, this may sound obvious, but it's worth saying out loud. If you wouldn't want to live somewhere without the appreciation potential, then you shouldn't be buying. Now let's talk about team rent, the smart decision no one congratulates you for. If buying a house is adulting, then renting is seen as the financial equivalent of still eating cereal for dinner. That's dumb, and it's for the have-nots. Renting is in many ways a power move. You get the benefits of shelter, location, and lifestyle without tying up hundreds of thousands of dollars in one illiquid asset. When clients ask me if they're wasting money on rent, I ask them this: would you say you're wasting money on food and transportation? Rent is not a waste, it's a cost, just like anything else you pay for that gives you access to something you need. You're paying for flexibility, mobility, and freedom from having to replace your own HVAC system. And most importantly, if you rent instead of buy, you can invest the difference, which brings us to the part no one likes to hear. Investing beats owning. When we run the numbers, renting and investing often beats owning in terms of long-term net worth. Why? Because the stock market has historically returned more than residential real estate, especially after you subtract mortgage interest, taxes, insurance, and repairs, and all the other bullshit that comes with owning a home. But most people don't think about this because real estate is visible wealth. You can touch it. You can post it on Instagram. Your parents understand it. And as I like to say, you can't throw a stock market portfolio warming party. Investments, on the other hand, are quiet. They sit in your account, compounding in peace while your cousin complains about property taxes. That doesn't mean no one should ever buy, but it does mean that the why has to be stronger than just because I feel like I should. Okay, but what do the numbers actually say? I get it. You want numbers, you want facts. So let's do a quick run through of the New York Times rent versus buy calculator, which answers the question, at what point does buying actually beat renting financially? This is one of my favorite tools that I've used dozens of times in client meetings. So here's our baseline scenario. You're looking at a $900,000 apartment in Brooklyn. You've got a $20,000 down payment saved, $180,000, which, let's be honest, not everyone has sitting around. The mortgage rate is going to be 7%. You plan to stay for 7 years. That seems reasonable. Property taxes are going to be $800 a month. The HOA, because it's a condo, are going to be $1,200 a month. And the comparable rent, you're going to do some searching on Zillow and you're going to see, hey, for what's a comparable place? If I can get a 2-bedroom for $900,000, what would the rent be for that place? I did a little bit of research. I found a place for about $4,000 a month. And then finally, what's our investment return going to be? We have to pick an assumption. So I'm going to pick, on the low end, 8% for our stock market portfolio to return. Now here's the result. Renting comes out ahead unless you stay in the apartment for more than 13 years. Yes, really. Even though you're shelling out $4,000 a month in rent, you'd still build more wealth renting and investing the difference because your invested money is working harder than your home equity ever will, especially in the early years when mortgage interest eats up most of your payment. But you actually have to invest the difference. That's the key. You have to be disciplined enough to actually make contributions to your stock market portfolio. And this is using conservative estimates. No bonkers NYC co-op special assessments, no surprise plumbing emergencies, no massive stock market booms, just plain math. The New York Times calculator takes into account the full picture: mortgage interest, closing costs, opportunity costs of the down payment, property taxes, inflation, and a realistic rate of return on your invested money. It's the closest you can get to what a financial planner would actually do, minus the part where we ask you how emotionally attached you are to having a breakfast nook. So why does this matter? Because the myth of home ownership as the ultimate financial move is still alive and well. Even though in many real-world scenarios, renting and investing gives you a better outcome and way more flexibility. This doesn't mean buying is bad. It means buying without running the numbers is bad. It means buying because you feel like you should or because you're scared of rent increases. It's not a strategy. It's a coping mechanism. So how do you decide? Here's a quick rubric based on dozens of client conversations that I've had. You should buy if you're 100% sure you want to stay put for the next 10 years. You can comfortably afford a 20% down payment and the monthly carrying costs. You value long-term stability more than optionality. You won't panic when the roof starts leaking or if home values drop 10%. You'll be able to rebuild your household emergency fund within a year to cover emergencies like a leaking roof. I promise you, your roof will leak. If you want to plant roots, raise a family, or become the person who owns a lawnmower. Another great reason to buy that I don't think is talked about enough is this idea of automated savings. If you decide one day to start contributing $2,000 to your stock market portfolio account, you can turn that off at any point, but you can't turn off a mortgage. You're going to do whatever you can to make that monthly payment. So for those of you who might be not so skilled at savings or have struggled with that in the past, I actually do think buying a home and having a mortgage can be a great move for you. But you should rent if you're not sure where you want to live long term. You work remotely or in a field with high mobility. You like optionality, liquidity, and low fixed costs. You want to invest in the market, not in your walls. You can admit that maybe you don't want to spend your weekends at Home Depot. The shame tax. I want to end with this. So much of this conversation is poisoned by shame. People feel bad for renting because they assume they've failed some invisible adulting test. People feel bad for buying because the house is too expensive or too much work or just not what they expected. People feel bad for getting help from their parents, and they feel bad for not having help from their parents. You cannot win this game by playing someone else's version of it. What matters is not whether you rent or buy, it's whether your money is working for you. Whether your housing costs are sustainable, whether you're building wealth intentionally, not just crossing your fingers and hoping the market appreciates. If you've made it this far, congrats. You're already ahead of the game. You're thinking about your financial life in a way that most people never do. That's the point of my content. And if you're still not sure whether you should rent or buy, here's your answer. Unless you're certain you'll stay somewhere for a decade, keep renting. Take the down payment and invest it. Buy a sofa you love. Learn to cook something excellent in your tiny kitchen. Be free. And here's my parting shot. I hope this post lives rent-free in your head and you can get over the conventional wisdom of home ownership.